Welcome back to The Next Big Risk. Jonathan Lewinsohn of Diameter Capital Partners and I spoke about the landscape of misinformation and how it affects Wall Street. He's increasingly worried about the massive unmarked sectors in the market that would cause problems if traders lose their objectivity.
The world is teeming with misinformation. It's deepfakes, it's AI, it's hard to work through. At the same time as this is happening, political identity is paramount, which means that people's political affiliation matters to their self-perception more than ever. And that doesn't only mean what their values are for the future, it's about what they think just happened. It's a debate about facts. Wall Street is supposed to be an island of objectivity in all of this. If earnings are good, the stocks go up. If earnings are bad, the bonds go down. But Wall Street more and more is adopting unmarked assets. Private equity, venture capital, private ABF, private credit. Those things aren't marked. Mark to market is what creates the need for honesty. And to me, the next big risk is, in this sea of subjectivity, in this changed environment, will investors really know what they own? Or does everything become Silicon Valley Bank and Lehman Brothers?
How does that make the job of an investor more difficult?
So let's step back first and play an experiment. I was on a trip recently with my 13-year-old son, and we saw a bumper sticker that said, "Inflation is a hoax." And he turned to me and he said, "I get misinformation, but," he said, "why would someone say something that you can see, like prices going up, is a hoax? What are they accomplishing?" And I laughed. But in reality, on Wall Street, as investors, we often rely on surveys of what people are saying in order to have a sense of leading indicators. During the election, it was Republicans who thought inflation was a problem and Democrats didn't. Now, magically, in January of 2025, it's flipped. And Democrats think inflation is a problem and Republicans don't. But it goes even beyond this issue of inflation that was a big one in our last election. We, for a long time, rely on just surveys of consumers, on CEOs, to tell us how things are. It helps us invest. It helps us understand the macro. And they used to be very, very valuable. But about 10 years ago, it changed.
If you're looking at an American public with two different views of the world, then how does that factor into decision making?
Well, we all know that from 22 to 24, everyone was obsessed with a recession. And it made a lot of sense. We all learned in school that if there's high inflation, rates go up, and therefore you have a higher probability of the economy slowing or contracting. But over time, what we saw was that hard data was doing okay. The economy was performing well. The soft data, particularly CEO surveys, didn't catch up with it. In prior periods, when there was worry about recessions and they were disproven, or by hard data, the soft data caught up, and it didn't this time. And in fact, when I would meet with senior investment bankers, I always asked them the question, what are the CEOs saying? Because they should have better insight than any. And throughout 22 and 23 into 24, they all said the same thing. CEOs tell me that their companies are doing great, but they're expecting a recession. We know from a Harvard Business School study that most CEOs are Republicans. At that moment in time, more Republicans thought the economy was going badly than Democrats did. And so that was reflected in surveys that investors tend to rely on. And so this objectivity, subjectivity that wasn't an issue necessarily in the past is now really challenging the ability of investors to rely on those type of factors.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. Being able to understand how your portfolio is performing relative to what's going on is not necessary for every type of asset, but if private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Do you think that too many investors are making decisions based on politics too often, whether they know it or not, because the views that are coming out are inherently political?
What we're learning as we look at society is that it's become impossible for us to divorce our political views from what we think is happening. And our political identities are paramount now. So why should Wall Street practitioners, when we enter this cube of our trading desk or the CEO suite, all of a sudden shed that which makes us human? All of a sudden shed the fact that our social media networks are giving us algorithms that are reinforcing everything we think. We read press that is biased all day long, and it's usually biased in a way to reinforce our views. So I think it would be highly hubristic for us as a community to think that, oh, we can avoid it here. Of course we can't. And therefore, if we're rooting for a certain political outcome, you have to be aware of that. And the argument that I'm making is we have a risk that Wall Street's objectivity will come under threat if they doesn't have the honesty push of mark to market. Those days when you get punched in the stomach by a change, to your point, it may be wrong. You may claw it all back. But boy, do you reassess everything you've ever thought about yourself and about your investments when your stuff is down.
What is it that keeps you up at night? What is the next big risk in your view?
I think the next big risk facing Wall Street is how do we remain objective in a sea of subjectivity? And when our incentives, the more and more assets are subjectively marked, are pushing us in that same direction. Does Wall Street risk it losing this island of objectivity that today, frankly, in this environment, is more special than ever? If our job is to be smart and fast in making investments, it's getting harder to do that because you have to spend a decent amount of time figuring out, hey, is this true? Is this really, is this a real video? Does this person know what they're talking about? And there's a cost to that.
Coming up, 6th Street's Josh Easterly. This is Bloomberg.